All right, guys. So, what drives this US dollar? US dollar is the DXY is primarily the Euro USD pair or the USD Euro pair. 68%, I think that's a basket. So, when people mention DXY, they're mostly mentioning the Euro USD pair. And I'll highlight right here. So here is the DXY, and I know this is the Euro USD, and I'll just overlay the DXY on top of this new price scale, and you'll see, look, it matches pretty much. So that's just the first thing. When everybody's saying US dollar, essentially what they're saying is US dollar strength versus the euro. So it could be, and essentially that's a ratio chart, right? All Forex pairs are ratio charts. They're one comparing versus another. And as in all Forex charts, one thing could go up in versus another while both are going down versus something else. Example, let's say US dollar measured in gold or US dollar measured in anything else, or inflation, for example. So while the euro, the dollar could be going up versus the euro, it could be going down versus PPIA. And you've seen us do this chart often. Look, it could be going down versus PPI. So while the euro is showing weakness, having the US dollar just skyrocket, the US dollar still is having trouble versus inflation. And right now it looks like it's back testing that breakdown line, and there's another one higher up, and then there is another one all the way up here. So this is a congestion area for US dollar adjusted for inflation. And this is the chart of the US dollar versus primarily the euro, or the actual euro chart. All right, so what does that, how can we get some clues where this is driving? And I did this exercise back, and you can't trade like a theory. Like, I know the milkshake theory is like popular, or there's other people say, well, it's this, there's not enough US dollars around the planet, etc. But how can you trade that? How could that give you clues of where the direction of the US dollar strength versus euro, where's that going? And I remember back in my Forex days, I was still trading Forex. I remember the big headline news that moved the Forex markets was interest rates. I remember those on those interest rate days, there'd be a movement on the smaller time frames, but that often could cascade or send a new trend in the higher time frames. So what I did here is I subtracted the 10-year yields for the US minus the 10-year yield for the euro. So essentially the delta, if the 10-year, the long term, or those 10-year yields attract people to the US dollar, and the 10-year euro yields attract people to the euro to hold euros, right? Because they're giving you that return, holding those dollars or those euros. The delta, not the ratio, the delta, the difference is like the carry trade, right? It's if you're holding one versus the other, that should drive capital flows for those currencies. I did this exercise, I think it was with the Fed fund rate minus the the ECB overnight lending rate. But look at this, guys. This one here, the 10 year, when it breaks down versus the euro lending rate, the 10-year, not the lending rate, the 10-year yields on the euro, the US dollar versus the euro was starting to put in the top, guys. Even here. So as this broke down, it's creating pressure for, okay, this is probably one of the elements. The US dollar now said, okay, I can't outperform the euro as fast. They're outperforming me on the 10-year yields. I'm losing traction versus that, and it's kind of putting a top here for the US dollar. Down it goes. Here, So here is the 10-year yield, now putting a base versus the euro. It breaks out versus the euro, back test, and off it goes versus the 10-year yield. What was happening at the same time? That was putting in a bottom for the actual euro USD pair. That's my dissector, the USD euro pair, putting in a bottom, and off it goes. So the correlation, I'll drag it down here. It's not a one-to-one correlation, but it is supportive evidence that this can help guide capital flows into the Forex market. You see here, not perfect. There's other elements in play. Here, the US dollar, the 10-year yields were breaking down versus the euro 10-year yields. Man, a lot of so that was a rising trend line. Here's a rising trend line. So as that started turning down, I'm going to put a horizontal line right here. As that was turning down, same thing that happened back in 2001. It was putting some pressure, and it was capping off the US dollar right here. Now, the US dollar, after this, went all the way down, refused to go lower than that. What's happening here, there's a longer term trend line morphing into existence. It's right here, guys. Move all drawings. What I'm going to do, I'm going to put this on a new pane so my drawings, they don't lose them. So while the US dollar has been doing new highs, and there's the Japanese yen in there, etc., Canadian dollars, British pound, the 10-year yield of the US minus the 10-year yield of the euro has not been doing new highs. So this is probable. We could be in a situation just like it did back here, back here, putting a stifle on the US dollar. This line down here, guys, and you'll notice this is important, this line here starts 2008, 2012, 2020. I'll show you a chart, because as soon as I see charts these days, right away there's like just a few type of, I call them major asset class charts, ratio charts, where they all look alike. And when they look alike, you know that it's like capital flows are driving, the same capital flows are driving these charts to behave in a certain fashion. So right now I have a paradigm breakdown line right here, right? And I know that eventually if this breaks down, this has a high chance of being a top for the US dollar. And this will also probably top out. And then after that, track this once again in that direction. These are the capital flows driving the US dollar. All right. This chart, guys, is the 10-year chart, the same one. So this is the Eurozone minus, well, it's the inverse actually. So this is the TNX minus a 10-year. But if you would flip it, it gives you this chart here. So the TNX minus a 10-year, but I flipped, sorry about it. I flipped the inverse scale because I didn't want to lose my drawings because they're attached to the actual ticker. So this is the euro minus a 10-year yield for the US. And that's that same line going down here. Let's say I would flip this inverse. It's this chart right here. And as soon as I saw this chart, I said, oh my God, this looks exactly like the gold to SPX ratio. So those capital flows going into the favoring the Eurozone 10-year yields minus the US 10-year yields. Man, this is tough dyslexia for me to say. That trend line here matches also the same trend line break for gold versus SPX. Look at that here. And gold to SPX is starting to move up. Here, right below, is the base, that possible bottom for those Euro 10-year yields minus the US 10-year yields. So now we got to give the benefit of doubt. Higher lows, US, the SPX divided by gold divided by SPX is approaching its breakout line. So yes, of course, it could revert down on its breakout line, but it's closing in on it. So now you got to watch out for breakout mode, right? For confirmed breakout mode. And that's where we are now. A lot of people, oh, it's going to turn back down. Well, it didn't even test it yet. So let's go see what it tests. And if both of those charts, if the euro 10-year yield can start breaking out versus the US and gold can break out versus SPX, those are two huge key elements that the US dollar is probably putting at the top. And I've shown other charts where the US dollar tops 1 to 3 months after gold breaks out versus SPX, after gold breaks out or bottoms. That's when the US dollar could keep like grinding up on its momentum upwards, but that the top is in. Eventually those capital flows will leak into the actual price, a spot price of the US dollar versus the euro, or the DXY will start climbing downwards. So those are the leading indicators for DXY going down. You could always wait for the DXY. Look, there's rising trend line here. Like on pure classical TA, you could just wait for these sleep mode lines. Here's a more aggressive one. You could just wait for these to break if you want, and then wait for a wick. Put that on a hollow candle and wait for a type of a blow off top wick. There's no rush to front lead this because the US dollar, it could keep going up. It could take many months to topple over. But the capital flows, the idea is that the capital flows feeding the US dollar will, that source of strength for the US dollar will subside once those 10-year yields break out in favor, minus the US 10-year yield break out in favor of the Eurozone and the gold versus SPX chart. So that's one big part of the element for that. Then we started looking at how's gold behaving versus the 10-year yields. How does that behave? So right here, I have a gold chart. This one right here, that's my gold chart, log scale on the quarterly. And then I have gold divided by the TNX. So that this one right here, that's the actual ratio chart of gold outperformance of those 10-year yields. Here, of course, when you have a ratio chart, you want to make sure that you want to understand which of the two instruments, which of the both instruments that you have in the ratio chart, which one is driving it most. When is that correlation picking up? When is that correlation turning down? So here I have gold. Here I have the TNX. So for that ratio, just remove gold for now. When it's above 0.70, it's a positive correlation. So that gold is actually in these periods here tracking the ratio. So as gold outperforms the TNX, that means gold is also going up. And here, when you're minus 0.70, statistically significant that the TNX, when it's below this area, that means as this chart's going up, that's actually the TNX driving it, and the TNX is going down. So right now what we have is, I did these drawings here, the correlation is actually 0.61. So the correlation with this ratio is dropping. So gold is losing its statistically significant correlation with the ratio. So as this ratio is dropping, guys, gold is refusing. So it's creating some bullish divergence. It's refusing to go down as much as the ratio is going down. While this ratio going down means the TNX is going up. So it's maintaining its positive correlation, the TNX, but gold is refusing to. Because look at that, the level it is now, that ratio, it's back at 2018 lows, it's back at 2013 lows, 2016 lows. Like, I'll overlay the chart. I'll put back the gold chart. Look at that. Gold is not back at these levels right here at 1100, at 1000, at 1200. It's not back there while this ratio is going down. Gold is sniffing out something else that's also driving gold, making it refuse to go down. So when I see this type of bullish divergence, what I'm waiting for is for that actual ratio to find some support. So right now, this bottom rail, 1, 2, 3, it's possible that this thing is going to go and retouch here. So the TNX might even keep going up, 10-year yields going up, whilst gold refusing to go up. And once that turns back upwards, I'm expecting the correlation to break out once again in favor of gold. So as this ratio, when this ratio breaks out back upwards, just like in the 70s, that ratio, there was no correlation with gold. And after that picked up, here, 99 and 2001, the correlation went down. as the ratio went down, gold refused to go down, so it didn't want to behave. It didn't want to track that ratio chart. It didn't let the TNX drag it down. And then after that, once that ratio started going up, gold started picking up its correlation, driving that ratio higher. And look, it happened here in 2018, the bottom for gold. Gold refused to go down while that ratio came and hit rock bottom. And then after that went up. And now the ratio is going down once again. So as soon as there's a breakout, along with all the other evidence that we pointed out, this could be actually, these are why I drew these lines right here, move. I'm keeping an eye right here. No, it's messy, but I'm keeping an eye here, wake up line, and this is what I'm expecting, another move up. So a correlation to repick up in favor of gold with the ratio, positive correlation, but as the ratio breaks out and not while it's going down. So that's the underlying strength I see right now with gold's behavior versus its performance with the 10-year yields, guys. That's how we can extract information from ratio charts. And because the first reflex is people, as soon as they learn about ratio charts, well, they could both be going up, both going down, one up, one down. Yes, all true. But the correlation indicators gives you changes, bullish divergence. I don't want to go down with the ratio anymore. That's what gold's telling you when it's the ratio, the correlation coefficient is going down. I don't want to go down anymore. All right, man, look at this. Everybody, all eyes is on SPX versus gold because I have like 100 years data. I get to see those 3 previous cycles from the 30s, the 60s, 2000s. But man, the Nasdaq on the line close seems to have broken down a while back. I think it broke down right here back in April of 2022. I think we have a convinced closed 1, 2, 3, 4, 5, a confirmed breakdown of that sleep mode line, and now a retest of that pivot line, previous support and resistance, a back test of the sleep mode line also, and that 3-year moving average is just keeping it afloat, guys. And here's the distance from the 3-year moving average. Let me do this one instead. You see, bull era for Nasdaq versus gold as it bounces on the 3-year moving average, then goes up, parabolic melt up, stretches to all time. You think it's Nasdaq's going to win forever, but it's overstretched. Breaks down, close below 3-year moving average, and then once it's below, these rallies towards the 3-year moving average were actually when silver, gold, they went ballistic. And until 2012, when it closes back above, then outperforming gold above a 3-year moving average, etc. Then that's a bull era for Nasdaq versus gold. Here I marked 154 bars, here 134 bars a month, here 127. And it's not quite there yet. Look at that. Oh, it did below. Now it bounced back up. Now it's right back on it, guys. Right back on it. Super close. Like I told Kevin this morning, it just needs a small push to fall off the mountain. And the difference from there, from what's happening here to what's happening into 2020, the angle of the trendline break, in 2020, there's a whole bunch of, maybe this one here, it's steep, the angle. See how I'm lowering it? The lower the angle, the more valid the message is, because that means the momentum's already slowing down to break down below a less and less slanted angle of ascent. Usually these steep angle of ascent breakdowns, the price keeps going up because there's still upwards momentum. So you broke down, you took it down a notch in momentum, but it could still grind up, right? And every time, even here, the breakdown in 2018, that was clear breakdown from this rising trend line, but there was still upwards momentum, right? Consolidate, then move up, etc. But as this line goes down, the momentum is dwindling. The next one's going to be here, less and less slanted. So, after that, until you get a horizontal breakdown line somewhere, and that is when the dog, the moose, or whatever, it's cooked. The chickens come home to roost, man. That's when this final breakdown line happens, guys. But look at that back test, close below 3-year moving average, gold, adjusted for gold, and now it seems to be bouncing down from that, continuing down. You could always wait for confirmation below this one, wait for the SPX to break down versus gold. But this is not looking very, very bullish at all for US equities. Here's another chart I did. I took the SPX divided by PPI. Orange, blue, red. Here I overlaid here on top. That's a silver chart just for you guys to see the behavior. When you get an orange zone here, silver goes up. When you get in the blue zone here, silver goes up. When you go in the red zone here, silver goes up. And these are all fractals. You see the black zone here? This is the red zone. Look at that. That could be playing out. Move that. Here's the blue zone. That could be playing out depending on, like, these fractals are happening, man. They all have the top, the bounce, and now they're breaking down below rising trend lines. Look at that. Rising trend line breakdown, stuff like that. So you see that? It could be that one. That could be a 960. That's my 1960s move. That's my 2000 move. This is the 1930s move. Like, way more violent. So it's kind of scary, but we're going to find out soon enough. If as soon as this line here, I have an alert. As soon as this line breaks down for SPX measured by PPI, it's like we're going to see it in the silver price, track that eventually, the gold price breaking out versus SPX, etc. That's another huge piece of evidence. It's a major analog. It's right there. So you get, those are the three previous analogs where right now they're on the table for these, either three, choose your poison, each one of these three. And look at that, these three analogs, they all look pretty much the same, guys. So all this zone here is bull era for commodities, gold, silver, uranium, oil, you name it. And then after that, once these break out to the upside, then it's like, I'm just going to put them here in that zone, one on top of the other, or maybe here. Then after that, once these start moving up, outperforming PPI, breaking out, then it's time to switch back into US growth stocks. Look at this one, man. This is the uranium divided by SPX on the daily chart. Huge base, or pretty good base from 2016. So uranium waking up, consolidation, flag above a flag, wedge, breaking out, flag, wedge, breaking out on the daily. And here is my 200 period stock indicator breaking out also, trying to make a move back in the bull zone. This is a 200-day moving average, bouncing up. So you'll see that this thing is a huge base. And once you close above, once we reach this breakout line here, the next one, then after that, once it gets above that, then you have these reverse symmetry moves, which is targets, which create targets and time to reach the targets, because the angle of this going down will be reverberated on the other side at the same angle going up. So that's a whole bunch of evidence, guys. And here's the final chart. This one I've been posting on Twitter. This the 1 hour chart. Look at that. We've had a base, our 5-star system. I saw that. I said, okay, fine. And I've just been tracking it. And you see the volatility on the 1 hour chart. All this stuff, it just builds out over time. You could zoom out, just go on the 4 hour chart, monthly chart. But here I'm zooming out. And right here, this is my monthly defined breakout line, which it's dragging up like all the way to the 2011 highs. So all this price action right here, I'm just going to hide all this. Look, it actually broke out probably on the daily chart. Huge base breaking out. Of course, it could come and retest. But now the target is all the way up here. And dot 50 closed at dot 51 on the monthly chart. That is actually the, let me put the monthly chart here. That is actually the breakout line from here, guys. Oh, yeah, it's messy here. Jesus. It's this line right here going downwards. That is the breakout line from this, what we call it's a wake-up line, essentially. And once it closes above that, then it's going to look like one of these lines here that closed back in 2001, 2002. Same type of line that closed here back in late 60s. So this is a whole bunch of evidence, man. If this line breaks out, then it knacks everything. the thing that got us excited back when gold broke out in June of 2019 was actually enrolled from 1200 all the way to 2000 was a bear market rally. So within this downtrend, there was like our wake up line. And now we know that the wake ups are rarely the moves that make it up back to the target on the first shot. That was just this tiny move right here. And then it hit horizontal resistance and then went back down. So here we are again, once again, trying to make a run to that breakout line. But now a lot of things have changed, because in 2018, SPX did not break down versus PPI. The angle of those rising trend lines were more steep, still have upwards momentum. So a whole bunch of stuff has changed since this rally here that created these crazy moves in silver, in the miners. Like, it was insane, just a small move. And now it's starting once again, guys. All right, guys. Thanks for watching.